Hey, what's up, guys? Brian Wong here, and in this video training, we're going to be talking about a concept that will both help you grow and protect your wealth in a very tax-advantaged way. And what we're going to be talking about is you've probably heard this marketing term thrown around a lot, infinite banking. And we're going to look at it through the lens of a deal sponsor for multifamily syndication, as well as a passive investor, because I actually invest in both ways. I'm a limited partner in two apartment complexes and a general partner in another two out here in Dallas Fort Worth. So I was looking, when I came across David and Erica, I was looking for a solution to. I was considering, what are the advantages of doing, a self-directed IRA, or what structure do I need in place to kind of give myself the best tax advantages. And I heard a lot of people doing self-directed IRAs. What is it called? Solo Ks,
Mhm.
um, EQRPs, different things like that. And there's a lot of different options out there. And there's a degree of complexity to it that a lot of people don't understand. And, when someone doesn't understand it, they say it's a scam or like that's not real. And I'm like, I did my own research. I had started talking to David and Erica, and I actually asked a lot of people in my network and wanted to get their opinion on it. And what I found was that there was a huge mixture and a lot of misunderstanding and people saying like, "Oh, don't do that. That's a scam." But then I look at the people who are actually using it, and they are some very high production syndicators that I respect a lot. And in addition to that, I mean, presidents of the United States use it. Joe Biden, Donald Trump both use it. The Rockefellers used it. So I mean, if they're doing it, there's a reason behind that. And so what we're going to do today is bring some clarity to why that is and how you can use it in your business. So welcome, Erica and David with Infinity Investment Strategies.
Thanks, Brandon.
Welcome.
So Eric, I'll let you start on that, especially with the president stuff. I like what do you say about the president?
So when we're Brandon, you bring up a good point. So I'm going to kind of bring this full circle. The When we're looking at this concept, IBC, it's infinite banking concept. That's exactly what it is. It is a concept. It is a strategy. It should not be viewed as a get rich quick scheme. That's not what it is. And the problem is, to your point, Brandon, there is so much misinformation. There is so much misuse or misunderstanding of this strategy in particular. But overall, the financial industry, right? Like David and I both come from traditional financial worlds. So what our experience has been is there's this my daddy can beat up your daddy mentality, right? Like, don't go use that guy, don't go use that product. If you do, they're terrible and everything's going to be bad, right? When in reality, we say this all the time, there is no such thing as a good tool or a bad tool. There are just tools designed to serve a purpose and to perform a certain function. And so finances are no different, right? There's no good or bad tool. But if you try to cut a piece of wood in half with a hammer, it's probably not going to turn out very good. And we can't get mad at the hammer, right? So, all of that to say, infinite banking is a strategy that needs to be understood. There is a degree of complexity to it, but there's also this degree of simplicity to it because once you understand it, it just becomes a normal part of your cash flow process. So, all of that to say, right, this is a strategy that's been used for hundreds of years. The Rockefellers have used it for generations. We have seen the Stanfords use it. We have seen Walt Disney use it. We have seen, to your point, multiple presidents use it. We've seen Joe Biden has it, multiple. I think Joe Biden has 8. Donald Trump has multiple. And so my joke, coming back to David's point, my joke is if Republicans and Democrats can agree on something, it's got to be pretty good, right? Like, especially those two guys. But the point is, coming to, Brandon, what you're saying is when we really look at this strategy and who is using it, how they're using it, and put it into the full context of, a cash flow strategy, well, that's when we start to realize, okay, this is a hammer. This is what it's designed to do. And I need to use it for its intended purpose. And the big thing is we understand that these people who are very wealthy, people who are very prominent, people that are very successful, right? Those that we want to emulate. I'm sorry, I'm not walking down the street and asking my, neighbor who has a subscription to Forbes magazine. That's not who I want to emulate, right? You're a great guy. I love you dearly, but I want to look at the most successful, wealthy people and see what they're doing and emulate that. And what they are doing is they are not chasing rate of return. They are not out there trying to put the most points on the board and trying to, now is that important? Yes, we want to grow, we want to build, but they understand that being efficient, protecting your assets, right? Tax efficiency, asset protection, having a good defensive role is just as important as offense, right? So we're from Texas. We love the Cowboys, but we know it doesn't matter how many points the offense puts on the board. If your defense doesn't hold the line, it doesn't matter. And so at the end of the day, coming to money, it's not about how much money you make, it's about how much money you keep. And your efficient processes and the things that you put in place to make that happen, that's what's going to really help you have that trajectory towards, again, emulating those kind of guys' success. So again, all of that to say, yes, it's all about the strategy. And when we see who's using it, then we start to realize, oh, well, maybe there is something to it.
For sure. Success leaves clues.
Yes. And when we're looking at this strategy, there's a couple of things that we really want to make sure that people understand. And I'm going to preface this, and I know David will want to chime in too. The big key here is, again, infinite banking's been around for a long time. It was really popular, and then it kind of trickled down. But it started rearing its head back up, and people started, coming back into attention of it back in the 90s when Nelson Nash wrote Becoming Your Own Banker. And that's great. We're super excited. We know that people are starting to remember how valuable this strategy can be. However, the caveat is if you are looking to do infinite banking, it's great. It's wonderful. However, you need to make sure that you're working with an authorized IBC practitioner. People who have the training, who have gone through the courses, who have gone through the interview process, who have gone through the proctored exam and have this regulatory authority, right? The Nelson Nash Institute actually monitors your processing, your behaviors, right? The policies that you're writing. They're watching everything that you're doing to make sure that number one, you're setting them up correctly. Number two, they're being used correctly. And number three, they're all on the correct platform to actually function the way that you're supposed to. You're not out there just schlepping products. So obviously we'd always want people to work with us, but really the most important thing is if you're looking to do infinite banking, before we talk about anything else, make sure that you find an authorized IBC practitioner, which can be done at infinitebanking.org. You can locate somebody either local to you. David and I are both on there. But that's incredibly important as we start to move into this conversation.
Very cool.
David, did you have something to add?
Yeah, that's definitely a good point because Brandon, I had reached out to you when you made that post kind of just to get a feedback from people around you and people that in your network on their thoughts on infinite banking, and definitely saw a mix of certain things. I will say that the people that are advocating for it were absolutely right, and the things that they were saying, that it's important to understand how to use the asset correctly and design it correctly. So to Erica's point, it's very important that you have somebody that not only understands the usage of it, but how to design the product correctly, and then going even further, uses it themselves maybe, right? Because even in the practitioner world, you have a lot of people that understand the asset, but maybe they are doing different things with it. There's a lot of things that can be done with it. It can be used for any sort of investments. It can be used for expenses. It can be used to fund businesses, college, purchase cars, all sorts of things. But I think in the world of real estate, it's important to maybe even take a step further and work with somebody that not only understands the structure in how to design these specifically for the product and the funding levels, all based around the IRS guidelines to maximize it, but how are they putting it into play in their own lives when it comes to specific real estate? So Eric and I, we have multiple policies. We understand the structure of it. We have a lot of financial knowledge. And then also we take it that step further of past the design aspect, but hey, this is how we're using it. We're using it in syndications. We're using it in passive deals. We're using it in, I've got short-term rentals with it. We've done developments.
New development.
We've done a lot of things together. So it's very important. And then the people that I think had some misinformation is they really just kind of parroting that traditional mindset, right? Where a lot of people I heard that were talking about it, they've either one had a bad experience with it because it wasn't set up correctly. It was set up more on a traditional whole life policy, which isn't a bad tool. Those are just built differently for different things. Those have their own functions, but for the acceleration of assets and the velocity of money through this type of strategy, it's not the most efficient. So they either had a bad experience with the way that it was set up and the way that it was designed. Maybe they were really just sold a product, not actually strategized on how to design one. Or they were just really parroting the traditional mindset of looking at rate of return or trying to analyze so much of the numbers that they're missing the big picture of the strategy around using the asset, right? The asset protection, the legacy piece, right? The banking arbitrage, the ability to keep future interest in-house, right? A lot of those, all of the features just together make it a nice package when it comes to strategy around what you're doing. And so many people tend to look at, they're very, focusing on one thing and missing the big picture, right? And then the last thing I'll say is you're right. The people that are really using this are people that are well respected in the industry or higher up, kind of financially elite or financially mature.
Mm-hmm.
We've had that conversation, Brandon. I mean, there's so many people that I think, that I've looked to emulate that are utilizing the strategy and doing it correctly because they see the forest through the trees. And then when you look at some of these other people like Donald Trump and Joe Biden, these high up people, these are people that are actually involved in making regulations and being involved in the regulation aspect. So if we want to continue to have these kind of tax benefits and everything, it's really a safe bet to do the types of things that these guys are doing, because if they're benefiting from it on a tax standpoint, they're not going to create regulation that is going to deter this asset from functioning the way that the way that it benefits them, right? So it's kind of a good scenario to follow so that, we know that, hey, if it's benefiting them, more than likely, because we don't know what tax changes are going to be like, more than likely taxes are going to go up. But if there's a place that has some tax benefits and these people that are making these regulation changes or have the authority to make these regulation changes, more than likely they're going to protect their own well-being in the sense of the things that they're doing. So in turn, that protects things that we're doing because we want to emulate what they're doing through some of these same strategies.
That's a really good point. And on that, I think, David brought up a good point that there's a couple of different areas. And Brandon, you mentioned earlier, your initial, exposure to this strategy was that you were looking for and you were looking for a strategy, right? You were thinking, all right, this is what I'm wanting to do. What's the right tool to fit that job, which is the perfect mindset, by the way. So I commend you for that. And so in looking at, the self-directed IRAs or solo 401ks or EQRPs, those are good tools, again, that serve a purpose. So when we're talking about infinite banking as a plug and play and making sure that, right, it's playing in concert with everything else. So there's a couple of things that we really want to point out. And let me just back up for a second. We call it the cash flow system or the flow and growth system. So we have our short-term needs, right? That's the day-to-day transactions. That's money that we need right now. So that money is safe and, safe, right? And it's liquid. We can use it and flow it in and out, but we're having to sacrifice the growth end. Okay. So this is money we need to use, within the next year, or we're losing money due to inflation. On the long-term side, well, that's money that, right, most people are putting it into like real estate or business. Some people do a 401k, mutual fund, stock portfolio, whatever, something that they're putting into so that over the long term, they can accomplish a level of growth, right? The caveat to that is, well, we're going to hopefully get some growth. We can't guarantee it, but the catch is it's not safe, right? No investment is guaranteed. And we know that money inside of investment is not immediately liquid. So it's tied up in that for, 7 or more years. So now we have this balance of, well, if I want safety and liquidity, I have to sacrifice growth. But if I want growth, I have to sacrifice safety and liquidity, right? So it's like this teeter-totter. And most people, especially syndicators, have this issue of, well, hey, I've got too much money sitting in the bank, but I don't want to put my money into another deal right now because I'm hoping to have this other deal come up within the next 6, 12, 18 months, 2 years, whatever it might be. So I'm in like this weird middle area. Well, this intermediate term is, hey, I need this. I might need this money tomorrow. I might not need it for 2, 3, 4 years. And it could be right perpetual. So, continuing that on for 20 years. But the point is, this intermediate box is the perfect fit for the infinite banking concept, because this allows you to do everything that's not being done by these other tools. You have guaranteed growth. Your money is safe. It's liquid, meaning, hey, I want my money. I'm going to call and they're going to have it wired right to me. So it's immediately accessible. It's tax-free, right? Like we always kind of joke, like this is a Roth on steroid. It's the rich man's Roth, but it's tax-free, but it also has the privacy piece. Okay. And so when we look at all of those characteristics, well, that's why actually Warren Buffett, he's another good example. Warren Buffett has called this asset the vault. And the reason he calls it that is, think of those characteristics I just listed out. If you have a vault in like your garage or basement or whatever, you can put money in when you want, you can take money out when you want. And Brandon, if you have a vault in your, house, who knows how much cash you have sitting in your vault?
You do. Right.
No,
just me.
else.
Just me.
Exactly. Now, it would be even better if your vault at home was giving you compound interest and dividends every year. But that's what these policies do, right? So they are completely protected from creditors and predators. But it allows us to have that intermediate term need. Hey, I want to put my money so I can protect against inflation, but I can turn around and use it to go out and invest in real estate. Because again, infinite banking is not your rate of return. This is not your accumulation tool. No one's going to write home to mom about, their guaranteed interest and dividends. I love when I get it. I'm not like, it's great, but I'm also using it to invest in real estate because that is my accumulation tool. This is my cash flow box. So, and you've seen the visual, right? We just say, hey, we're going to take money out of our bank, put it into our policy so we can fund it into real estate. We pay it back from real estate into our policy. We pay our policy loans back. And then because we have additional cash because of the arbitrage, guess what? Now I have more money going into my bank. But if I have too much money in my bank, guess what? You just rinse and repeat the cycle, right? So, that's where our infinity sign comes in. So spoiler alert for anybody that hasn't seen that yet. But the whole point to this is not something where we're just going to set it and forget it and put it to the side and hope and pray it all works out. This is actually a cash flow plug and play strategy. It's not combative. It's not saying, hey, do this instead of. No, this is saying, put this into your cash flow system so you can do more real estate, so you can do more development, whatever it might be. This is helping you be able to continue and exponentially grow everything else that you're doing, right? So again, it's designed to be collaborative and work alongside. It's not an either or. This is what they call the and asset.
Cool. And I guess one of the things that was compelling to me is that with an IRA, you were limited. You're severely limited on how much you can put in.
You know what the R in IRA stands for?
I don't.
Restriction. I'm just kidding. I'm the funny one of me and David, just so you can tell. But that's kind of our joke as well, because like you said, Brandon, there's a lot of hurdles to overcome when you're dealing with those. So anyway, I'll let you continue. I just had to throw that in there.
Oh no, this is your show. I want to let you guys do the talking, and you have the expertise. I guess, can you speak to that in terms of like how much you can put in depending on the policy size?
Mm-hmm.
Yeah, sure. So yeah, the IRA definitely a lot of restrictions to that, a lot of government control, regulation, all of that. With the policy, obviously the IRS does put some limitations around how much you can fund it, but you can control that. There is a minimum and a maximum corridor, but you dictate what that minimum is, and as that minimum goes up, so does the maximum, right? If the minimum goes down, so does the maximum. Once you reach that design where you've got that perfect correlation of, okay, here's my minimum, here's what the IRS says that I can maximum put in. If you raise that minimum, it goes up. So you can control that. So, people can put in, four figures, five figures, seven figures, nine figures, right? It's all really just based on their finite budget and how much they want to fund it. So, just know that, as you get up to that higher level, that's going to raise that kind of minimum. So, there definitely is a lot more flexibility on how much you can fund it. So if somebody wants to put in, millions of dollars into this thing, they can. They're just going to have a larger minimum than somebody that, puts in a six-figure type policy, right? So one thing I will say too with the IRAs, going back to that regulation aspect, you've a lot of that is very, it's reported, it's not really private, it's government, is monitoring all of that, the money ins and outs. With the policy, going back to Erica's point, it being private, and kind of your own vault. What's interesting, what I love about it is obviously the privacy behind it, but the ability to, make it known if I want to, right? So if I want to put that asset on my PFS, which is my personal financial statement, as liquidity, I can. So I can go and apply for a loan. I can go and apply for, whatever investment I'm doing, and I can say, yes, I've got this liquidity available to me. Now, they love that in the sense that that's a liquidity credit, but it's not collateralized unless I choose to. So I can choose to collateralize that. So I can go a step further and say, okay, here's my liquidity, but I also will go ahead and give this up for collateral to maybe get some sort of a loan, better loan terms. So I have those options and that flexibility, which is very, very important to me, is the ability to have different options on how I use it. And then things like my daughter going to college and applying for different types of aid. I can not show those cards, so I can hide that liquidity if I want to. I don't have to tell them that I have this money in multiple policies. So when they're looking at my financial scenario where any sort of 529 plan for her or any IRA or any money in the bank or anything at all is going to negatively impact her ability to get additional support from any sort of additional funding or financial
Scholarships.
aid or scholarships or anything like that, I can hide that. So I can hide those cards, I can keep them private when I want to, or I can display them and really, so there's that aspect. And then I think the second thing that I really love about this is the protection piece, because specifically when we come to real estate, right, we always talk about ways to, to reduce liability, right? Because we love the control aspect that real estate provides, right? In the sense of being able to control, what asset we're in, kind of control through value add, control through development, creation, right? There's certain things that are out of our control. So how can we protect ourselves? And we know that, LLCs has a certain layer of protection, but it's not bulletproof. There are things like bad boy rules, certain things out of our control. We want to trust our partners, right? We trust but verify, but things can happen. LLCs can be broken. Bank accounts can be drained, right? Even my house, I'm building a house on the Brazos here in Granbury. As soon as it's done, just like my previous house, because I'm renting right now, but my previous house I sold was in an irrevocable trust just to protect that. And then a majority of my assets are in these policies because if there's something out of my control, even if we're driving to Dallas and we get we hit somebody in an accident or something and they sue us, right, and it's above what our insurance covers, they can come after all of that, but they cannot touch the cash value in the policy because it is tied to my legacy, which is that death benefit. So the way that it's structured is a very interesting structure for that piece. But that's a huge deal that I think a lot of syndicators really find value is that protection of their assets, right? And that liability of that, because something happens, you've got a majority of your liquidity now that's untouchable, that once the dust settles with that lawsuit, whatever it may be, right? We don't want to talk about those because we don't ever want to be there. But if it happens, once that dust settles, we can kind of pull money out of our back pocket. We can really have a better opportunity to start fresh, start over, and really pick up the pieces and move on. Whereas Eric and I, we've heard multiple stories of people we've talked to that have had scenarios like that where they've had to literally start over almost 100% because of some lawsuits, certain things that they've happened, certain partners running off with money, certain things, right? That stuff's out there. So having that protection piece is huge on that as well.
Yeah, that's
Mm.
there's really 4 things on that, right? So David touched on a couple of them. We call it the 4 pillars of infinite banking. And the first one that we talk about is lower taxes. So my background, David did a lot of the stock trading, derivatives trading, all of that fun stuff. I did more of the pension and retirement planning, way back when. But my experience in that world was, people are so worried about the tax liability today that they cut their nose off to spite their face, and they end up paying more taxes later on than they ever did while they were working. And I know people right now that are doing that. And so, David mentioned this earlier, our tax bracket's going to go down? Probably not, but we need to find that happy balance. So with infinite banking, we want to help people lower taxes. So the first thing that we say is, all right, well, let's lower them today and later on. So when you're investing in multifamily or really any real estate, one of the biggest benefits to that is the depreciation. That's a huge benefit. Well, when you're investing with for example, a self-directed IRA, they're a tool designed for a certain job, but you do not get any depreciation, no cost segregation or anything. So that blows my mind. But a lot of people, especially when they get into multifamily that have had self-directed IRAs, they might use them once and they're like, all right, I'm not doing that again because I see the benefit of depreciation. So infinite banking allows us to take advantage, full cost segregation and bonus depreciation while we still have it. You're also able to use your dollars and the growth that's accumulating. You can use that throughout your entire life, completely tax-free through the loan strategy. So even as your money is compounding, you have access to that without having to pay taxes on that. And then whenever you get to a phase where you're like, hey, I don't want to work as hard, I might just want to kick back and, just collect that check, you can say, hey, I don't want to put money into this thing anymore. I want it to start paying me, because everything we're doing is building up cash flow assets, right? That's all of us are building up these cash flow assets. These policies are no different. This becomes one more cash flow arrow in your quiver so that you can flip the switch and it will start to pay you a guaranteed tax-free stream of income for the rest of your life. It's uncorrelated to the market. It just pays you and it's tax-free then. Lastly, when we eventually graduate from this world, right? I stole that term, but I love it. When we graduate from this world and we, leave our assets behind, these policies are the most tax efficient way to transfer wealth from one generation to the other. Brandon, you mentioned the Rockefellers. They wrote a whole book about this called What Would the Rockefellers Do? And it talks about cash flow banking and them using policies like this to transfer wealth, because there's no inheritance, no estate tax, no income, right? There's no probate, no wills. It is a clean cut transfer. So on the tax piece, we're able to lower taxes today, use our money tax-free while we're working, get tax-free income when we decide to flip the switch, and everything we leave behind when we're gone is tax-free. So we have that balance between now and later. David mentioned the control, right? You get to, number 2 would be increased control. So you get to decide how little or how much. That's completely up to you. But here's the kicker. And we actually saw this. The most recent example that David and I ran into was in 2020. And if let's say you take a loan against your policy and you're going to, you pay that back, and we have the strategy for that. But there's times where, let's say something happens where I can't pay this loan back. Or, we saw multiple people who are syndicators and passives Well, guess what? If I'm not getting my cash flow because they've stopped distributions like they did in 2020 with all the eviction moratoriums and all of that, well, if I'm not getting these distributions, I either can't or don't want to make a payment on my loan. Guess what? You don't have to. You are the banker. You have become your own banker. So you set the terms of when you pay that back, at what, pace you pay that back. The company sets the simple interest rate, right? But you get to decide how you pay it, when you pay it, at whatever pace. So we saw syndicators who put a pause on it for a little while. You're not getting ugly letters or calls from me and David say, hey, penalties, things like that. We saw a guy do a new development that he planned on taking, about 2 years or so. Ended up taking almost 3 years to get this thing completed. He did not make a policy loan the entire time, not one. And again, no penalties, no ugly letters, none of that. When he was finished with his development, guess what? He paid off that policy loan all at one time and then rinsed and repeated the process and just cycled it right back through. So having that control and that peace of mind of, okay, worst case scenario is something is going on and I either don't want to or can't pay that back. Guess what? You're not up against a wall in the midst of all this chaos. So that's on the control piece. In addition to what David said, you're able to increase your leverage, right? So increasing your net worth and liquidity on your PFS, you're able to hide it. But on that risk piece, that's the biggest area, not just on the creditor side or predators, right, being afraid of being sued. This is the only uncorrelated asset that puts you in a position of true diversification, right? So for example, when the market goes up, these IBC policies go up. When the market goes down, these IBC policies still go up. And the beautiful thing is most real estate, like really good real estate opportunities, tend to present themselves in times of a down market. So if my liquidity is tied to the stock market, but then the stock market goes down and now there's real estate opportunity, I'm having to lock in losses. So with infinite banking, we're saying, hey, your policy is guaranteed to increase every year. So you are in buying power. You hold the leverage at that point to be able to capitalize and be able to go out and gobble up as much as you possibly can in that opportune time. And you're, putting yourself in that position of the leverage, of the risk. You don't have to worry about that. The last thing I'll say is, I think David has a joke about the FDIC and leaving money in the bank and how much they, what do you say about that? How much they have actually insured versus what their reserves are? Do you remember what the numbers are?
Yeah, it's basically a little over 1% that's actually in reserves to the amount that's supposedly insured.
Insured by the FDIC.
Yeah.
Okay.
Good.
Yeah, and that's the concern is if people talk about bank runs, it's not a fictional thing. We've seen it. We've seen it in Canada. We've seen it over in Europe, right? We saw it here in our own country, 100 years or so ago. But the point is, it's not an apocalyptic scenario. It's not if, but when that case happens. And I think David says, how certain are you're going to fall into that 1% to be able to access your cash, right? So the difference is when we have our actual liquidity and our actual assets protected inside of these policies, we only work with A+ rated companies. In order to get that rating, they have to have 100% minimum, 100% liquidity to be able to pay at any time. So if every single policyholder went in and wanted to cash out, they would have the ability to be able to do so. And so again, 2020 scenario, because it's the most recent, we had a guy, he owned 120 units outright in North Carolina. And he needed, right, I think it was like April or so, he needed a little bit of liquidity just to kind of manage through that time. And he had about $1 million in equity in his home, in his primary residence. He went to the bank, he wanted to get a HELOC so he could use that to help funnel into his apartment. Well, bank told him no, they wouldn't do it. Right? So it's one of those things where do we really own something if we have to ask somebody else permission to use it? And that was a really frustrating time for him because usually when we need money the most is when the economy is unstable, and that's when banks tend to tighten up on credit expansion. So these policies, they don't have any restrictions. The only thing they're going to ask whenever you call in to get a loan is how much do you want and where do you want it sent? That's it. And they send it over. So it's a sense of relief to be able to say, hey, this is my money. I'm taking back control of it. I don't have to jump through hoops. I don't have to prove anything, report anything, right? It's putting that position of power back in the investor's pocket.
something big to add to the control piece for deal sponsors who are buying properties. They like an IRA, you're not allowed to invest in your own deal, and with this structure, you can invest in your own deals.
Absolutely.
That's a huge control piece for sponsors, because I've seen deals where there would be two separate GPs and they both had IRAs. So like, hey, I like your deal, you like mine, but I'll invest in yours, you invest in
Yeah,
mine.
scratch my back,
Yeah.
I'll scratch
Yeah,
yours.
that
Yeah.
you don't need to worry about like doing stuff like that. You
Mhm.
can just use your own funds if you want to.
Yep, that's definitely huge. A lot of benefits to syndicators in that aspect, as well as just protection. I mean, there are groups or syndication groups out in Florida and Tennessee that I know of specifically that have actually structured these types of infinite banking policies in a way that, you know, it has a couple of purposes for it, a few purposes. One, and we can get into some specifics. I think, Brandon, you mentioned we were going to make this a multiple part series, which I think is benefit because we can really start to get in on some specifics, but just kind of a general conversation starter here. You know, similar to, and of course, I don't think we've talked about this, but J.C. Penney's, for example, in the Great Depression, right? Nobody was buying retail. They took a loan against their corporate owned life insurance policy to allow them the liquidity to pay their employees during this time where it was basically a cash flow crisis, right? They weren't getting the cash flow to pay them. So they were able to do that and sustain that depression, because what happened after the depression, the economy, you know, started coming back up. People were buying retail again, so they weathered that storm. So a lot of syndicators a few of these syndicators I've seen, I think a lot more starting to realize this, is use this as, you know, a kind of a business scenario where you can set up a trust, you can set up certain things, LLC, you can have just kind of a general thing. You can have, you know, the owner of the policy, the payer of the policy, the insured, and the beneficiaries can all be different. You know, the beneficiary has to be a person, but the payer and the owner can be an entity, different things, right? So you can structure this in a way where each member of you know, manager of that syndication team has a policy where they are the insured and the beneficiaries are each other. So in a sense, it can function as a key man, because, right, let's say that you have a strong team, you're doing multiple deals, and you have a guy who's plays a very important underwriting role or asset manager role. Something happens to him, right? So it's beneficial to have a key man type deal, you know, that's kind of protects the other people. And then what you can do is obviously the LLC group, or, you know, the LLC or trust can pay for these types of policies and can actually have, you know, connection to the cash value. So what these groups are starting to do is really set this up to where they're using the liquidity in these policies to either use earnest money for their own deals, fund their deals, but also, let's say in 2020, where there was a cash flow crisis, where you know, they could not pay their investors. Well, instead of just stopping to pay their investors, right, they actually were utilizing the infinite banking loans to help pay the cash flow to their investors. Because, you know, what started to happen was, you know, the government was starting to fund, you know, have these different types of programs and things that were starting to refill that bucket. So all along the way, they didn't just stop paying their investors. They continue paying their investors, even in a scenario where they were taking loans against their policy to pay their cash flow, or to cash flow their investors. Let's say the anniversary rolled around, they were getting the dividends, they were getting the growth on the policy through that banking strategy. So they were continually getting the earnings on that. And so they didn't lose that future value, but they were able to pay investors. And then, similar to like JCPenney's, as business picked back up again, or as these programs, these government programs were coming back in and cash flow started to pick back up, they were able to refill that bucket. The asset started performing again, and where now the asset was paying their investors. So in conversations I've had with some of these syndicators, I mean, that developed a huge bond between their passive investors in the way that they were able to structure that. So there's, there's that aspect as well to continue. I mean, how valuable as a passive would that be to have a syndication team that, in a scenario that was out of their control, was actually better prepared for a liquidity crisis to continue to pay cash flow investors, or to pay cash flow to their investors, right? So I think that's kind of an advanced conversation that we can certainly have. I think the first step, obviously, would be for syndicator to understand the basis of the policy, the structure, how to use it on a personal level, and that's where we kind of really start the highlight. How does this work as passive? Because it's really easy to understand kind of cash flow in, cash flow out. But as syndicators start to go to kind of phase 2, phase 3, that's when they can really start to take advantage of understanding some of the more advanced strategies through this by utilizing the asset in that way. So that's something that we can certainly dive into, and further on in this series, and start to look at how that can be structured, because I think that's a huge advantage for syndication.
Yeah, that's a really good example.
That's particularly crucial when you have pref equity in play, and
Yes,
you basically have a gun to your head if you don't make those payments.
Yeah.
They're going to kick you out of basically kick you out as GP and take over. Like,
absolutely. Because worst case scenario, I mean, worst case, it falls apart, and everything falls apart anyways. You're right. The money is still paid for investors. That bulk of the money that the syndicators got on the deal through acquisition fee or whatever, they've lost that. But what's the most important in this scenario is paying this private equity, paying pref equity, because deal goes south, syndication team, you lose your money on that deal. You don't want to be in a position where you can't get investors on another deal, right? I'd rather lose the money on the one deal, and because of that deal, that time frame goes south, but paying investors on it, because when things do pick back up, I can go to them again and say, hey, we as syndication team got a bust on that deal, but hey, we made sure you guys were taken care of, right? Because you're first our priority. So moving on, let's look at another deal. Come with us, right? So,
and those guys are going to talk, right? Because there's other syndication teams that aren't prepared for that. So when your passives are talking to other passives, and they're able to say, hey, what value do you add? And because at the end of the day, that's the question, right? Like, what value do you add over team ABC? David and I have gotten that question. We actually just got that question last week, right? Like, hey, I can do infinite banking. I can go talk to whoever. What's the value add? And I know David touched on this, but I mean, I can't tell you how many times we've gotten the feedback of, hey, I've talked to people, they understand infinite banking and they get it and they're knowledgeable on it, but they don't really know anything about real estate, or they know about real estate and they don't know about infinite banking, right? So to be able to marry those two, obviously that's the value add that David and I bring, and we've really dove into this particular area. The very last thing, we haven't really touched on this yet, I want to make sure we cover it. David alluded to this, but in the process of taking out a loan and still continuing to earn on that policy, that's that loan strategy. So we are going to go into more details on that, to actually give some, examples on the case studies for the different designs. But just from a high level, these policies, again, when you use the right one and they're structured correctly, that's important. We are using non-recognized loans. So for easy numbers, if you have $100,000 and you take out 70, if you have an IRA or a bank or whatever normal account, well, at that point, you're only earning interest on the 30,000 left over, okay? But when you have become your own banker, you have $100,000, you take out that 70, you borrow against your policy, and it goes out into XYZ investment. Doesn't matter, because again, you can use it for whatever you want. But right now, I would say 99.9% of people, when they are getting an acquisition fee or an asset management fee or cash flow from a property, they're just taking that money, putting it into their bank account to turn around and use it again. The same scenario applies. You take that, except you're going to put it into your infinite banking account instead of a traditional bank. The difference is that as you're cash flowing that money back into your policy, you had 100, you took out 70 to go invest. Your policy the entire time has still continued to earn compound interest and dividends on the full $100,000 value. So when we talk about helping investors enhance returns and expedite what they're doing, that's what we're talking about, is being able to do what Robert Kiyosaki says, give $1 multiple jobs, and we can earn dual rates of return by doing exactly what the banks do, which is Brandon, I'm going to pay you. You make a deposit, I'm going to pay you 0.02%. I'm going to turn around and loan it to David at 6 or 7. We're going to create arbitrage just like they do. And that's what really, when people are looking at the strategy, they see that. That's kind of their first, like, oh, I like that. And that's kind of what gets them rolling into it. Everything else that we talked about is really the glue that holds everything together. And when we realize, hey, it's not just about rate of return, it's about all these other things. But I wanted to make sure that, we address that, because we've alluded to it a few times in this conversation.
Yeah. Banking is the most profitable business in the world, right? I don't think people realize how profitable banking is. And, we talk about, being successful. I think one of the biggest things when you're starting to look at certain things, outside the traditional box, as you're learning, you really want to, first off, you really want to emulate people that are having success, right? If I'm looking at somebody that's having a lot of success, my first question is, hey, what are you doing? And how can I do that? Right. And I want to take that from multiple different angles. So for banking, I mean, if I can emulate the most profitable business in the world, right, I'm going to do that. So that is it. You're right, Eric. It's predicated on that banking. Now there's so many other facets to the benefit of infinite banking when it comes to some of these things we've talked about. And then of course there's, some other things that we can kind of get into later when it comes to really keeping that future value and how this asset functions really well as an income, as a cash flow tool, is kind of a almost like a self-made kind of income pension tool, right? So we can get into a lot of that. So I think the next phase for this would be to dive in a little deeper, to maybe we go over some case studies of a passive investing in a deal, and what this looks like. We can look at some illustrations, some real illustrations. We can look at, I've got some calculators that go through some of the borrowing strategy, and we can kind of put them side by side and really just start to show the numbers and the visualization of what's actually happening on a passive side, I think, because we'll start there. And that way the passives would really benefit from understanding how they can plug this into what they're doing and their scaling. And then, we can start to maybe get into some of the more, syndication side and maybe look at some of the more advanced strategies using, ILETs, which are insurance trusts, using LLCs to own and pay for this, and maybe, implement this for a syndication team and how they can really structure it around their liquidity and avoid, a cash flow crisis for their investors, and really just set themselves apart from other syndicators, because you're, as a syndicator, right? And this, Brandon, the deal doesn't happen without your investors. So, they are the most important piece of this. Obviously the asset itself and how you manage it, but none of that happens without the equity partners, right? So if there's a way for a syndication team, if they've already got it down where they've done all of the due diligence, they know how to asset manage, right? And they've got all of that. The one thing that sets them apart is, well, hey, we're structured in a way where we are using strategy around what we're doing so that we can take care of the investors first and foremost. That's going to build longevity to a syndication team and really make them successful. Absolutely. Right? It's keeping that loyalty with their investors. So I think that's phase 2. We can look at the passive side and then really start to move into the syndication. And we promise we'll bring some numbers, some calculations, some really nerdy stuff, man. That's I love the nerdy stuff. So because
Brandon's seen a little bit of it. He got to
especially those engineers out there who, because I know a lot of engineers get into multifamily, so they're gonna love. They're like, yeah, this is all great, but show me the numbers. So
they want to see the numbers behind the numbers. Like we have a guy that, we have a lot of engineers that are clients, but it is a process, and I will say, David and I, when we launch this, we are not transactional. This is not something where, we just, hey, here's an infinite banking policy. We slap your butt, you're out the door, right? Like this is something where we have gone into this so thoroughly with people on the front end and after the fact. Hey, you've got your policy in place. Let's do a real estate analysis. Let's look at how you can put this in play into your real estate or your business, or even at home, right? With, like David talked about, you can finance your own personal expenses, whatever it might be. The point is, we go into this incredibly thoroughly to make sure that there's an understanding. Engineers just like to really get to the root of it. But that's something we've done on a regular basis. And we particularly appreciate that because we know that going through that work, and once somebody truly not just understands it, but they have fully digested this and they understand it, they are so full in, right, that they will continue. The more you use it, the more you will use it. But then they're also communicating, we function a lot of referrals. And so for someone to be able to say, hey, I've wanted to learn about this for a long time, but I've never been able to really understand it or how to put it into the rest of my system. I will tell you, and I told this to a friend of ours, right, Kristen. I told her, I said, you haven't talked to me yet. Because she told me, I've heard people talk about infinite banking, but I've never made that connection. I said, you haven't talked to us yet. And sure enough, right, she had the conversation, she went through the process, and she's like, there's the light bulb moment. So to be able to go into the details of that and the math and the numbers, and David has some great calculators, there is value in that. And I think that'll really help a lot of people in the multifamily space.
Awesome.
Yeah.
So
what other questions, Brandon?
Yeah.
I know you've had your exposure to that. Anything that you feel like we're missing?
We'll probably dig into the details a little bit more in the next video, but for people who you had touched it very briefly, saying that it's like a supercharged Roth. So from a functional standpoint, we're putting post-tax dollars in there, but they can grow to infinity with zero tax consequence. So I think that's a pretty important point that we just glanced over real quick for people.
Absolutely. Yeah, good point.
So
that's huge because, and we'll get into this a little bit more because, we're building all of our portfolios through these different types of investments in real estate and all of that. And the main thing that we're trying to do is maximize our cash flow because, and I've talked to a lot of people, we're very similar. And what's our one goal that we're trying to do? And that's to buy back our time. And we do that through maximizing cash flow, right? To have that lifestyle that we want. So I think that, even in real estate, with it being such a great tool to build true prosperity, we are at the mercy of these people that set these regulations and taxes, right? So those can change at any time in capital gains tax. All of these things around cost segregation, bonus depreciation can change. This asset here, I love because of the way that it does function, in the sense that you can set it up to be a tax-free. It functions so well. I know when we talk about, Erica mentions, it's not a rate of return asset, right? I mean, it does have its functionalities of its rate of return, but it really, really shines on the back end when we want to really turn it into a cash flow asset and tax-free. And I think in my, almost 20 years of financial experience, this asset, whole life insurance, if set up correctly and set up and funded and utilized along the way, it really does function better than anything I've ever seen, better than your 401k, better than real estate. I'll even say that, and people fully understand it, better than anything out there. It functions a lot better on the back end for a tax-free cash flow asset. So when you couple that with certain things, when you marry it with a 401k as a volatility buffer, when you marry it with real estate and all of the things that you're doing, then I think you put yourself in a lot better position to maximize cash flow, even if there are regulation tax changes down the road that affect some of these other things. You still put yourself in a position where you do have a part of your portfolio that is not subject to those types of regulation changes. And I think when people really start to see the forest through the trees and understand, if we can really show people that not only how to use the strategy along the way, but how does it function as an income tool with this type of strategy while it continues, kind of as an actuarially, right? Because these assets were really predicated on our grandparents' pension, right? And what are pensions? It was lifetime income, and they were really played a huge role in creating that type of pension for somebody. So I think when people fully understand not only the benefits that it plays as the earlier stages in life, our accumulation stage, but also how it functions as a distribution asset, it really just makes sense. Just completely makes sense. So looking forward to diving into that, a lot further when we look at some specifics and look at numbers. So absolutely. We appreciate it, Brandon. We appreciate giving us the opportunity to come on. I think this is going to be a great platform for us to take a little bit more time to go through some of these things. I think because we run about a 3-meeting process with clients, and it really does. And then of course, like Erica said, we're not just transactional. We do kind of help them through multiple things, but I think to have kind of a one place where we have a several part series where we really start to hone into some of these different aspects where we just touch on in our meetings, I think it'll be really beneficial for new people that are being introduced to the strategy, and even people that are already clients of ours that we've gone through, that we can kind of point them to this kind of compilation of different types of stages of the benefits of this asset. So appreciate
it. Review and refresh, revisit a lot of that, because like you said, it's hard to do all of that in that.
Yeah, and dive in a little more detail. Absolutely.
It's like taking a drink from a fire hose too. Like,
Yeah.
So I was like, man, I wish I recorded that. So
yeah,
this will be very beneficial, I think, for the viewers, including myself. So all my detail-oriented, hyper-analytical people, don't worry, because our next call will be diving into those details as well as case studies for syndicators. So, and as well as passive investors.
Yeah.
So,
I know they're sitting behind the screen right now watching this saying, hey, this sounds good. Show me the numbers.
Where is it at?
Yeah.
Where's it at?
I've got truth concept calculations, loan strategy calculators that people haven't even seen in our presentations that will be able to really dive in and plug, actually load illustrations into this through loan analysis and all sorts of stuff. So we'll get nerdy with it for sure.
Cool. Well, for everybody who's watching this, I hope you guys enjoyed this training, and we'll see you at the next one. Take care now. Bye-bye.